Electronic Arts Inc. financial model is a financial model of a North American interactive home entertainment industry giant private placement by a consortium of investors, including the Public Investment Fund, Silver Lake, and Affinity Partners. The company has been experiencing stagnant growth for the last 3 years prior to the take private transaction announcement. Its operating margins have remained subdued relative to industry average. The company has been returning cash to shareholders rather than reinvesting in growth opportunities, and EA stock prices have underperformed both NASDAQ and SPX over the last 5 years. The deal is structured as an largest all-cash take-private transaction reverse triangular merger as of September 2025, and is financed with $36 billion of sponsors' equity and $20 billion of debt. The model includes tabs such as cover, the summary dashboard, assumptions that includes all of the hardcode assumptions for different schedules on the model tab that flows through the model, the sources and uses of fund representing the split of financing, including debt, the $20 billion of debt and equity across both operating company and holding company, balance sheet, transaction fees, as well as purchase price allocation and creation of goodwill. Best based on worst case scenarios for growth assumptions and revenue drivers. The historical tab representing the historical performance of the company over the last 5 years, including the income statement, cash flow statement, balance sheet, historical covenant and credit statistics, and relative performance of the metrics with respect to industry average, interactive home entertainment industry average, historical net revenue and historical net booking, as well as historical charts representing the financial performance of the company relative to industry averages. A 3-statement financial model tab under the PE-led management team, including revenue schedule, cost schedule, income statement, cash flow statement, and balance sheet that are fully linked, the recapitalized balance sheet, the pro forma balance sheet post-transaction close, given the goodwill created in the deal, the amount of new debt, as well as the equity injection in the company to purchase the company, depreciation schedule, working capital schedule, tax schedule, debt and interest schedule, shareholders' equity schedule, covenants and credit statistics. Last but not least, the operating company and holding company IRRs and the dividend flows from operating company to holding company to finance the expenses such as cash interest and paid in kind interest expense, as well as any dividend payment to the investors throughout the forecast period prior to exit, an exit year from 2030 to 2037, the exit IRRs, cash on cash multiples, and value add for all the 3 different investors given their investment in 2025, the sensitivity analysis of IRR with respect to exit multiple, the sensitivity of IRR multiple of invested capital, and fair value per share of the revamped company as a function of the debt split across operating company and holding company balance sheet, given the sum at $20 billion, with the debt ranging from $2 billion to $20 billion on the operating company balance sheet. A sensitivity analysis of leverage multiple of debt over last 12-month EBITDA, given the amount of debt on the operating company balance sheet. And as we know, the credit rating agencies are going to rate the bonds of the company as junk rather than being an investment grade bond. The valuation and the value of control under the PE-led company, and the sensitivity analysis of the implied value per share as a function of terminal growth rate. The status quo valuation, which includes the valuation of the company under 2 approaches, a discounted cash flow valuation and relative valuation and comparable company valuation, and a fairness opinion of the offer price which includes a range of the implied value per share and the sensitivity of the implied value per share as a function of terminal growth rate and the reinvestment needs across the forecast period. The model also includes a comparable company valuation and price ranges, risk measure calculations for the purpose of valuation, including beta, unlevered beta, cost of debt, equity risk premium, country risk premium, and cost of equity and cost of capital calculations. Calculations of market adjusted, risk adjusted measure of return represented by Jensen's alpha, which determines the performance of the management team relative to comparable companies historically. Forward multiples including price to earnings, EV over EBITDA, EV over sales, price to FFO across all comparable companies for forward year 1 and forward year 2, as well as the multiples across all the players of interactive home entertainment industry, and the notes and the sources that were used for the due diligence, and an automated summary dashboard representing the base, best, and worst case assumptions of the exit IRRs, multiple of invested capital and value add, the status quo valuation, and implied equity value per share range for determination of fairness opinion, relative valuation, as well as the sponsored-led company valuation and the value of control under the base, best, and worst case assumptions. A comprehensive report describing transaction structure, valuation methodologies, fairness opinion logic, leverage allocation between OpCo and HoldCo, return drivers and sensitivities, investment consideration, and anatomy of a leverage buyout and criteria which makes a successful private placement target is included in the package.